What's going on? My name is Garrett. I'm your local tax guy, and it is Lazy Sunday. So instead of a suit and tie like you were probably expecting, I'm in a hoodie. I have not shaved, as you can tell. But today we're going to talk about term insurance, why it's better than whole life. And I've got to admit, I made a little bit of a mistake. I gave you a problem, didn't give you a solution when I ranted about whole life insurance. So today we're going to talk about why term insurance is better and why you should probably go get a policy. Let's do it. Let's talk briefly about the purpose of insurance. Insurance is not an investment. Insurance is not there to make you money. You are not trying to get rich or wealthy off of insurance. Insurance is there to protect any assets you may own. For example, if you have a house and you get a life insurance policy on yourself, should you die earlier than expected and you do have a spouse, but you have a mortgage on the house, you don't want your spouse to have to sell the house in the event of your death because you can't make the mortgage payments, or he or she can't make the mortgage payments, you get life insurance. That protects them from something like that. So should something ever happen to you, they get a large sum of money that they can use to pay down whatever liabilities you may have, if it's a house, a car, anything. This would also allow them to cover your income. So for example, if you're making $2,000 a month, you may want a life insurance policy to cover that should you pass away, so that your spouse can keep an income stream flowing in. When it comes to life insurance, the two policies you hear about the most are whole life and term insurance. Okay, so what is term life insurance? Term life insurance is basically an insurance policy on your life that is going to pay a set amount if you die within an X amount of years. For example, if you get a $500,000 20-year term policy, then if you die within 20 years, your designated beneficiary will receive $500,000. Now that we know what term insurance is and how it differs from whole life, let's talk about why I suggest term over whole life. So whole life, we've gone over the negatives. Term, we've gone over what it actually is. I think most people would be better off just buying a term insurance policy and investing the difference. Let's go over a brief example just to show how this would work. So the whole life policy, we go to an agent and we get a quote, and the agent quotes us a whole life policy for $500,000 for $250. Now this agent's probably going to say, like, it's an investment, it's great, you should do it because I make more money. They won't actually tell you they make more money off of it regardless. And then you get quoted, after you get that quote for whole life, that he or she tells you $250, you ask for a term insurance quote for $500,000, 20 years, and they say $50 for that. Honestly, it might be a little high if it's a 25-year-old male with no pre-existing conditions. I digress. Conservative numbers, let's say 50, and it makes the math easy. So you have 250 for the whole life, you have 50 for the term. Take the 250 that you would have paid for the whole life policy, subtract the $50 that you're paying for the term, and you have a difference of $200. Take the $200 and invest it. What does that do? Let's go over the facts. Now we're covered for 20 years. And if he dies within those 20 years, his designated beneficiary, let's assume his spouse, is going to receive the $500,000. Now this could cover a mortgage or any liability he may have. Typically it's a mortgage or just a source of income. Let's say the individual doesn't die, which is great. He gets to 45 years old, but his policy, it expires, it lapses. He now has no coverage. But he's been investing $200. That is the quote unquote cash value that he would have had in the whole life policy had he been paying those extra premiums. He's been investing it in a brokerage account. Now, I've done some math here, and I'm going to put a chart up somewhere. And if you look at the $200 that's been invested monthly for 20 years, I assumed an 8% rate of return, which is what the S&P 500 has averaged since its existence. So that's a fairly safe compound interest rate. So if you look at the graph, it's pretty amazing. You're looking at a final number of just over $100,000. So let's talk about, we get to that point and then he dies, our individual dies. Well, hopefully by that point, his mortgage is paid down enough where he doesn't need the $500,000 anymore. I mean, that's honestly a bit excessive. He's been paying on a mortgage for 20 years at this point, assuming he stayed in the same house. Even if he moved houses, the mortgage on his current house is probably much lower than it was before. And he has an extra $100,000 now to pass on to his spouse should anything happen to him. Now, in 20 years, also at 45, he likely has maybe kids in school or something like that, but at least he has the $100,000 that he's able to give to his spouse. Now, how could we mitigate this issue even further? Well, instead of doing a 20-year term, we could do a 30. Now, all of a sudden, our individual is not 45 when his insurance lapses, his insurance coverage expires. He's 55. At 55, you're talking about an entirely different ballgame, hopefully, if he's done everything else he should be doing. So, a 55-year-old male, hopefully, his house is paid off. His kids, by this point, are hopefully out of college, and he's sitting pretty. To be quite honest. And then you have $200 that you've been investing this entire time. So to conclude everything, we've protected ourselves for 20 to 30 years in case anything happens to us, and our spouse can also get a policy. So assuming you're a married couple, both you and your spouse can get a policy, one policy for each of you. And basically that ensures that should one of you pass untimely, that the other spouse is protected. Even if you don't have a spouse, maybe you have kids, should something untimely happen to you, your kids are protected. And that's the entire goal. Now, with term, we discussed this earlier, it is just that. It is a term. It is just a period of time. But if you extend that period to 20 or 30 years, or if you're say 40 years old and you just get a 15 to 20 year policy, it will be more expensive, but you're just ensuring that period of time with the hope that once you hit the end of that time period, let's say your insurance expires, you don't need that money anymore. Hopefully you have, outside of insurance, outside of protecting yourself, you've been building wealth along and along and along over the years, which is the goal. That should be the goal anyway. Again, insurance is just to protect. It is not to build wealth. So you're going to build wealth other ways. I keep doing that. You're going to build wealth. You're going to build wealth other ways through investments, through your 401k, your IRA, your Roth IRA. You're going to do that other ways. The insurance, again, is just to protect you. So hopefully by the time you hit that period in life where you're 45, 55, 65, you don't need life insurance anymore. And to be completely honest, you're not going to want it because it's going to be much more expensive at that time. So in conclusion, hopefully that kind of explains everything, that kind of lays the groundwork of the way I think about it, and any way I kind of try and guide clients when talking about that issue. Now, I must say, this is not specific to your situation. I am a CPA, I am an advisor, but this is generic advice. This is very general. You cannot take this and run with it and say, well, Garrett told me to do this. I don't know your situation, quite frankly. You should most assuredly check with your financial advisor or your CPA before taking anything I say literally today. Outside of that, I hope this helped. If you will, drop a like if you like the video, if you love the content. It helps support me, it helps the YouTube algorithm, it helps tell people about my content. If you think of any changes, anything you want to see discussed in a future video, if you think of anything that should be changed on this one, if you have any corrections or anything like that, please drop a comment below. Let me know, because it does help. I don't get an ego about it. Anything you can tell me to help make my content better is certainly appreciated. So thank you for watching this video, and I look forward to seeing you guys next time. Thanks.